BOXX ETF versus actively managed funds, which wins for safe investments? Welcome back to Chat ETF. Today we're diving deep into a new player on the scene, the BOXX ETF. They're promising safety, stability, and potentially even higher returns than Treasuries. But with a name like BOXX, you might be wondering, what's in the box? Is it a magic formula for market-beating returns? Or is there a catch hiding beneath the surface? We're about to crack open the BOXX ETF and see exactly how it works. Stick around as we explore the BOXX ETF's investment strategy, its potential risks and rewards, and how it stacks up against similar options. By the end of this video, you'll know if the BOXX ETF deserves a spot in your portfolio. Let's get chatting. Question 1. What is the investment objective of the BOXX ETF? The investment objective of the BOXX ETF is threefold. 1. Track the performance of short-term Treasury bills. It aims to deliver investment results that mimic, or even exceed, the price and yield performance of an investment that follows the 1 to 3 month sector of the United States Treasury bill market. In simpler terms, the BOXX ETF seeks returns similar to what you would get if you directly invested in ultra-short-term government debt. 2. Offer tax efficiency. Unlike regular Treasury bills, which generate interest income taxed at potentially higher rates, BOXX ETF aims to achieve similar returns with potentially better tax treatment. By using an options strategy, BOXX spread, the fund strives to deliver primarily capital gain tax treatment on any profits. Capital gains, depending on the holding period, can be taxed at a lower rate than interest income. 3. Manage risk. Similar to Treasury bills, the BOXX ETF targets a risk profile comparable to Treasury bills. These government securities are considered among the safest investments as they are backed by the full faith and credit of the U.S. government. So, while BOXX ETF uses options to potentially enhance returns and tax efficiency, it seeks to maintain a level of risk similar to these ultra-short-term bonds. Here's a breakdown of how BOXX ETF tries to achieve its goals. Underlying strategy. BOXX spread. The fund utilizes an option strategy called a BOXX spread. This involves buying and selling call and put options at specific strike prices to create a defined range for potential returns. Targeted returns. By implementing the BOXX spread, BOXX ETF aims to capture returns similar to short-term Treasury bills while potentially limiting downside risk. Tax efficiency. The option strategy employed by BOXX ETF may result in capital gains rather than interest income. This can be advantageous since capital gains may benefit from lower tax rates compared to interest income, depending on the investment timeframe. Important to remember. BOXX ETF is actively managed, meaning a fund manager makes investment decisions. This adds an element of risk compared to passively managed funds that simply track an index. The price and value of BOXX ETF shares will fluctuate. There's no guarantee the performance will perfectly match Treasury bills, and you could potentially lose money. Question 2. How does the BOXX ETF achieve its stated objective? The BOXX ETF achieves its stated objective through a combination of strategic security selection and an options strategy known as a BOXX spread. Here's a detailed breakdown of each element. 1. Underlying holdings, mimicking Treasury bills. The BOXX ETF primarily invests in highly liquid, ultra-short-term Treasury bills with maturities ranging from 1 to 3 months. These government securities are seen as some of the safest investments as they are backed by the U.S. government's promise to repay the principal amount at maturity. By holding these short-term Treasuries, the BOXX ETF aims to replicate the interest income earned on these bills. This income reflects the prevailing interest rates set by the Federal Reserve for these maturities. 2. The BOXX spread, engineering returns and tax efficiency. This is where it gets interesting. The BOXX ETF goes beyond simply holding treasuries and utilizes a BOXX spread option strategy to potentially enhance returns and achieve tax benefits. Here's how it works. Buying and selling options. The fund manager engages in simultaneous purchases and sales of call and put options on a specific underlying security, often a treasury note or bond with a maturity slightly longer than the Treasury Bills held by the ETF. Call options. The BOXX ETF buys call options at a certain strike price, let's call it X. A call option grants the right, but not the obligation, to buy the underlying security at price X by a specific expiry date. Put options. Simultaneously, the BOXX ETF sells put options at a lower strike price, let's say Y. A put option grants the right, but not the obligation, to sell the underlying security at price Y by the expiry date. Creating a defined range. This combination of buying a call and selling a put creates a defined range for potential returns. As long as the price of the underlying security stays within this range, between strike prices X and Y, by the expiry date, the BOXX ETF captures a return similar to the interest earned on the held Treasury bills. Capping upside potential. It's important to understand that the purchased call option limits the potential upside of the BOXX ETF. If the price of the underlying security significantly increases above strike price X, the ETF won't fully benefit from this appreciation. The premium paid for the call option acts as a cap on potential gains. Potential downside protection. The sold put option, however, offers some downside protection. If the price of the underlying security falls, the put option can be exercised, forcing the BOXX ETF to buy the security at strike price Y. This can help mitigate some losses, compared to directly holding only Treasury bills. 3. The tax advantage. Capital gains over interest income. The beauty of the BOXX spread lies in its potential tax benefit. Since the BOXX ETF's returns are primarily derived from the difference between the premiums paid and received for the options, these profits are often classified as capital gains rather than interest income. Capital gains tax benefit. Depending on the holding period and your tax bracket, capital gains may be taxed at a lower rate compared to interest income. This can lead to a more tax-efficient return for investors in the BOXX ETF. Key points to consider. The BOXX spread is a complex strategy. While it can enhance returns and offer tax benefits, it also adds an element of complexity to the BOXX ETF. There's no guaranteed outcome. The success of the BOXX spread relies on the price movement of the underlying security remaining within the defined range. If the price strays outside this range, the BOXX ETF's returns might deviate from the targeted results. Actively managed fund. Unlike passively managed index funds, the BOXX ETF is actively managed by a fund manager who makes decisions about the specific options and underlying securities used in the BOXX spread. This adds an additional layer of risk compared to passively tracking an index. Question 3. Does the BOXX ETF employ any leverage or derivative strategies? The BOXX ETF indeed utilizes a derivative strategy, specifically a type of option strategy called a BOXX spread. Let's delve into how this works and why it doesn't necessarily translate to leverage. The BOXX spread, a defined risk strategy. Core of the strategy. The BOXX ETF employs a BOXX spread by simultaneously buying and selling call and put options on an underlying security, often a treasury note or bond with a maturity slightly longer than the treasuries held by the ETF. Breakdown of options. Call option purchase. The ETF buys a call option at a specific strike price, X. This grants the right, but not the obligation, to purchase the underlying security at price X by a certain expiry date. Put option sale. Simultaneously, the BOXX ETF sells a put option at a lower strike price, Y. This grants the right, but not the obligation, to sell the underlying security at price Y by the expiry date. Defined range. This combination creates a defined range for potential returns and losses. As long as the price of the underlying security stays within this range, between strike prices X and Y, by the expiry date, the BOXX ETF captures a return similar to the interest earned on the held Treasury bills. Why not leverage? While the BOXX spread involves options, a key characteristic differentiates it from leverage. Limited potential loss. The sold put option might seem to introduce leverage as it creates an obligation to buy the underlying security at price Y if the price falls. However, the premium received from selling the put option offsets this potential loss. Defined risk profile. The maximum potential loss in a BOXX spread strategy is limited to the difference between the premiums paid and received for the options. This contrasts with leverage, where potential losses can be magnified. Similarities to leverage. Potential for amplified returns. The BOXX spread can magnify returns if the price of the underlying security moves favorably within the defined range. This can resemble the potential gains associated with leverage. Complexity. Both leverage and BOXX spreads introduce additional complexity to an investment strategy compared to simply holding underlying assets. In essence, the BOXX ETF uses the BOXX spread to potentially enhance returns and achieve tax benefits, but it does so with a defined risk profile, unlike leverage which magnifies both potential gains and losses. Question 4. How liquid is the BOXX ETF? The liquidity of the BOXX ETF is a relatively new topic as it launched in December 2022. Here's a breakdown of factors influencing its liquidity. Positive indicators. Underlying holdings. The BOXX ETF primarily holds short-term Treasury bills, which are highly liquid assets with a massive secondary market. This translates to a readily available pool of buyers and sellers for these bills, ensuring the ETF can easily buy or sell them. Underlying option liquidity. The BOXX spread strategy often uses SP 500 options, which are considered some of the most liquid options contracts globally. This suggests the options used by BOXX ETF can be readily bought and sold in the market. Growing assets under management, AUM. As of December 2023, the BOXX ETF has surpassed $1 billion in AUM. This indicates growing investor interest, which can contribute to a more liquid market for the ETF itself. Potential considerations. Newcomer status. Being a relatively new ETF, launched in late 2022, the BOXX ETF might not yet have the same level of trading volume compared to more established ETFs. This could translate to slightly wider bid-ask spreads, which means a potentially larger difference between the price a buyer is willing to pay and the price a seller is willing to accept for a share of the ETF. Underlying BOXX spread complexity. The BOXX spread strategy itself adds a layer of complexity compared to simply holding assets like Treasuries. This complexity might deter some investors, potentially impacting overall trading volume and liquidity. Overall assessment. While the BOXX ETF is a new player, the underlying holdings, Treasuries, and the use of highly liquid options suggest it has the potential to be a liquid investment. The growing AUM further strengthens this notion. However, its recent launch and the inherent complexity of the BOXX spread strategy could lead to slightly lower liquidity compared to more established ETFs. Question 5. What are the primary risk factors associated with the BOXX ETF? The BOXX ETF, while aiming for safety and stability, comes with its own set of risk factors. Here's a breakdown of the key areas to consider. 1. Credit risk, relatively low. Limited exposure. The BOXX ETF primarily holds ultra-short-term Treasury bills issued by the U.S. government. These are considered some of the safest investments globally as they are backed by the full faith and credit of the U.S. government. The risk of default on these treasuries is extremely low. Indirect exposure through options. The BOXX spread strategy involves options on underlying securities, often treasuries with slightly longer maturities. If the issuer of these underlying securities defaults, there could be potential losses for the BOXX ETF. However, the short maturities involved and the typically high credit quality of these underlying treasuries make this risk relatively low. 2. Interest rate risk, moderate. Impact on Treasury yields. The returns of the BOXX ETF are closely tied to short-term interest rates set by the Federal Reserve. If interest rates rise, the value of existing bonds, including those held by the BOXX ETF, can decline. This is because investors would prefer to buy newer bonds offering the higher prevailing interest rates. Limited impact from BOXX spread. The BOXX spread strategy used by BOXX ETF aims to generate returns similar to short-term treasuries irrespective of interest rate movements within a defined range. However, significant interest rate fluctuations outside this range could affect returns. 3. Market risk, moderate. General market volatility. Even though the BOXX ETF invests in relatively stable assets, broader market downturns can impact its liquidity and price. During periods of panic selling, investors might rush to sell their holdings, including ETFs, driving down prices even for assets considered safe. Option strategy risk. The BOXX spread strategy itself adds a layer of complexity compared to simply holding treasuries. If the price movements of the underlying securities deviate significantly from the anticipated range, the BOXX ETF's returns might be lower than expected. 4. Management risk, moderate. Actively managed fund. Unlike passively managed index funds, the BOXX ETF is actively managed by a fund manager. The success of the ETF relies on the manager's skill in selecting the appropriate options and underlying securities for the BOXX spread strategy. Poor management decisions could lead to lower returns or unintended risks. 5. Liquidity risk, potentially low, but new ETF. Underlying assets. The BOXX ETF holds highly liquid Treasury bills. However, the ETF itself is a relatively new entrant, launched in December 2022. This could result in slightly lower trading volume and wider bid-ask spreads compared to more established ETFs. Monitoring liquidity. Keeping an eye on trading volume and bid-ask spreads can help assess the BOXX ETF's liquidity over time. Overall, the BOXX ETF offers a potential trade-off between risk and return. By focusing on short-term treasuries and using a BOXX spread strategy, it aims to deliver returns similar to these safe investments with potentially better tax efficiency. However, it's not without risks, including interest rate fluctuations, market volatility, management decisions, and, to a lesser extent, credit and liquidity risks.